friends, welcome to Nirmal Bang. I'm Piyush Jain, and today we are bringing to you a new company, a new IPO, which is coming up on the bourses. This is a company which has created its own legacy over the last many years in the aviation e-commerce space. I'm using the e-commerce word very interestingly. The name of the company is almost a household name if you actually are using air travel. We're talking about Yatra Online Limited. And this is a very synonymous name. Again, if you're booking air tickets, it's something which almost all the air travelers would be using either Yatra or their peers. But now this company has decided to get listed, and we actually have seen the DRHP, and very soon the IPO will be with you for the subscriptions are going to open up. Let me welcome the management so that we can understand more about the company. Let me now welcome Mr. Rohan Mittal, the Chief Financial Officer of the company. Rohanji, welcome to the show.
Thank you, Piyush.
Uh, let's start first about the company. Help us understand the business model on the top view for our viewers, for any layman who would be looking from outside. It appears that you book tickets in wholesale in advance from the aviation companies are offering to the retailers or retail consumers, individual consumers, and thereby you must be making fee income. But help us understand, like how correct we are thinking and what's the sort of overall operating model.
So the company was set up 17 years ago in 2006, and the intent was to disrupt the travel market where everything was happening in an offline mode, and the intent was to convert into an online mode, right? So that's the basic simple ethos with which the organization was set up 17 years ago. Today, we are a full stack technology company which offers multi products on the travel and hospitality side across B2B and B2C customers, right? So what does that mean? On the B2C side, there is our flagship portal called Yatra.com, where you can book a gamut of travel, hospitality related services such as air tickets, hotels, holiday packages, bus, cab, train. The entire product range is available. Uh, on the B2B side, we are the largest today in the Indian market, and we offer our services to corporates of the country in managing their employees' corporate travel. In addition, we also have more than 29,000 travel agents which are empaneled with us across the length and breadth of the country, because still there is about 25% of the ticketing which happens in an offline mode in the country. It's not happening online, right? So the travel agent network that we have today in the country helps us tap into that market as well. So we are covering all these different parts of the market. At the back end, we have strong multi-year supplier contracts, which allow us to service these ticketing that are happening through either of these platforms.
Okay, so we're talking about hospitality, which is hotels. We're talking about, again, airline companies. What else you talked about apart from this?
We have trains, we have buses, we have visa, we have travel insurance, anything
Okay.
and everything that you could imagine as far as travel is concerned.
Yeah. So
We believe we would be servicing.
sure, let's go one by one. On the aviation side, how's the working capital cycle happening here? Like when you actually do multi-year contracts, do you have to actually put up any money as a guarantee deposit, or it's nothing like that? Like how's the working capital flow happening here?
So the working capital can be considered from two aspects. One is at the supplier end. Um, More than 90% of our business gets transacted across airline ticketing and hotel, right?
Mhm.
For these
Mhm.
90% of these suppliers, almost in entirety, everything gets transacted on an advance cash and carry model, basically. We don't have to keep any bank guarantees, etc., per se, as far as the Indian airlines are concerned. It's all on cash and carry basis, right? The other way to look at working capital, Piyush, is on the customer end. In B2C, there is no working capital required, but on the corporate side, we do offer credit to a few corporate customers,
Okay.
which requires some bit of working capital to be deployed from our end. So there are two
Mm.
aspects to the working capital requirement.
Right. And how much is B2B of your total business?
On a current run rate basis, my B2B is trending at about 42% and B2C is trending at about 58% on a current run rate basis.
Okay. Almost basically same. Almost same. 40 to 58. So when we're talking about the sort of B2C business first, whether it's hotels or it is aviation, as those two are your primary source of revenue. In that, basically, is that something where a traveler books a ticket through you, and you actually book the ticket then on the airlines, and then basically a sort of fee gets credited to you? Is it a simple business model like that, or then there are particular sort of uh, any sort of other thing also associated with that?
I mean, under the hood, there'll be many moving parts, but the way you've described it is fairly appropriate, Piyush. So let's say if you are booking a Delhi Mumbai ticket on yatra.com, your credit card, or you can use credit card, debit card, UPI, buy now, pay later, any of those mechanisms, right? So let's say you are using a credit card. So your credit card would get debited immediately. And in a fraction of a second, our account will get debited as well in favor of the airline with which the ticket is getting issued. And your ticket would be in your mailbox or on your WhatsApp or SMS on almost an immediate basis. So yes, it's a
I,
back-to-back chain which gets transacted.
Sure. Just out of curiosity, one question. I'm just assessing the moat here. Many airlines, they also have been trying to popularize their own sort of websites or apps, whatever you want to say, like Indigo is trying its own, and the other ones also. How they basically are a threat or a sort of competition in their own, because you're buying from them and they're also trying to actually sell on their own on their website. So, how much is that sort of I should say a threat or basically a competition? What's your observation?
See, we believe different sales channels are always going to be available to the suppliers to market their product directly.
Sure.
However, the convenience of comparison of fares, comparison of timings, comparison of airlines or hotel products, etc., is something which only an OTA such as ourselves can actually bring to the customer. And therefore,
Right.
we continue to see a healthy traction, which is reflected in the fact that our application, mobile app, has been downloaded more than 25 million times till date. We have more than 180 million footfalls on our website. So that just goes to reflect the kind of penetration that we have done. I think the second point is the fact that Yatra, as you rightly mentioned at the beginning of this conversation, is a household brand, right? It's synonymous with travel. I think the effort which the company has put in building up the brand during the early years is now reflected in the fact in the nature of app downloads, footfalls, etc. So we don't treat that as a competition per se. I think it's a healthy mix of different sales channels which are available to the customers. At the end of the day, the customer should get a seamless travel experience, whether they book it directly with the airline or through an OTA. I think at the end of the day, they need to get a very seamless travel experience.
Right. Makes sense. And from the perspective of hotels, both in hotels and aviation, there is a seasonality here. So when you're talking about Christmas, it's a very holiday season. The fares they go up. But when you're talking about sort of an off season, the fares actually go down. So typically, both in hotels and aviation, is there something where actually you have an advantage of any sort of having any available inventory with you from the your sellers, or is there something which you're able to offer a sort of better proposition to your customers? Like I'm also trying to think from a corporate clientele perspective also.
So I think yes, there is seasonality across travel consumption. Fortunately, because as I explained earlier, 58% is B2C for us and about 42% is coming from B2B. The price elasticity or price inelasticity is very different for a leisure traveler versus a corporate traveler, right? If a corporate traveler has a meeting scheduled in a city and has to travel, then has to travel, right? I mean, whether the price goes up by 10-20% or comes down won't really be a material factor feeding into the decision of whether to travel or not. In the case of leisure travel, yes, price could play a role, and therefore seasonality does crop into picture. As far as so for us, given that we are at a 58-42 split, uh, both sides of sales tend to hedge each other or offset each other during strong seasonality volatility. As far as inventory is concerned, Piyush, we have very, very limited bits of inventory with us, only for very, very high demand customer requirements during the peak seasons, as you rightly called out. So we hold very, very limited bits of inventory. It's a very, very small percentage, less than probably even 1% of the sale that we do. We are
Okay.
trying to get, my apologies, we are trying to get into that on the back of using data sciences to forecast the kind of demand that is going to come, so that if at all we procure inventory, we should not be saddled with anything which expires, right? Obviously. So we are now trying to use data sciences to our advantage. Let's see how that pans out. Still early days on that, but yes, that's what really we are doing.
Yeah, that's something which is useful, and that was one of the part of the answer which I was looking for, because that is something which is really important in the digital business. But now going to your area, which is the more interesting part, and that is help us understand the flow of revenue to EBITDA to net profit, how it has been for you over the last reported year, a year back, maybe perhaps whatever months you can talk about in the last 6 months, but how it has been, because that sort of pass through is slightly different in terms of structure for Yatra. So help us understand the better margins and the sort of profit margin flow here.
Sure. So I'll refer to the FY23 numbers, the audited numbers, for the purpose of this walkthrough. Uh, Again, going back, 90%, 92% of our business gets transacted across airlines and hotels. So I'll specifically refer to those numbers because they are far more pertinent to the balance long tail of products that we may have. On the air side, our earnings, and this is what gets called out as revenue, would be adjusted revenue, would be around 7.7% for last financial year. So every 100 rupee ticket that gets sold, on that there'll be a 7.7 rupee adjusted margin that we make. Um, Against this, and on the hotels and packages side, this number is close to about 13.6%, right? This gets clubbed together as adjusted margin in my reported numbers, right? This number was close to about 615 crores for last financial year, FY23, on 6,740 crores of total ticket sales, right, annually.
So
Uh,
the I'm just interrupting. When you're
Please.
saying that the fee is a net revenue for you, right? Or you're saying that the fee is a net EBITDA for me, because you use the
Mm.
word margin also and then revenue also.
So, adjusted margin is a non-GAAP measure, right?
Okay,
It basically reflects the take rates that we
right.
earn on the ticket sale because we act as an agent. When
So
you when
that's
you
the net
consider
revenue for you,
us,
right?
right? That is that is not net revenue because it is net of customer inducements and marketing cost. Net revenue is
Sure.
reported after reducing customer inducement and marketing cost as per Ind AS, right? So there's a difference between adjusted margin and the revenue from operations. You can call the net revenue as revenue from operations, probably, if that's all right.
Hmm.
That number was close to about 397 crores. The difference between
Okay.
the two is the customer inducement and marketing and promotion cost. When we talk about adjusted margin, that reflects essentially our take rates from these
Hmm.
suppliers as well as whatever fee income we are earning from the customers as well. So that number on a 6,740 crore of ticket sales for FY23, that number was close to about 615 crores, just about
Okay.
9%, 8.59%, which is a blend of air, hotel, package, and all other services, etc., pulled in together. Against this, we reported an adjusted EBITDA of 67 CR. When I say adjusted EBITDA, it's basically my EBITDA adjusted for listing expenses and my ESOP costs, right? There's nothing else. So we earned about 11% in terms of adjusted EBITDA margin.
Hmm.
Against a 67 crore of EBITDA, we were able to deliver a 7.6 crore of PAT. This includes the depreciation amortization of the technology that we have created and capitalized over the last few years, which includes my corporate self-booking tool, etc., which is a very, very important tool for us to service our corporate requirements, corporate travel requirements.
Just
Uh,
Rohanji, just to recap, what's the EBITDA you talked about for FY23?
67 crores.
67 CR, and the total
Adjusted
profit,
EBITDA.
adjusted EBITDA, and then the profit we've reported is 7 CR, right?
7.6 crores. That's right.
And the revenue from operations, we are reporting that number stands at what are the numbers?
397 crores, which includes 380 crores of revenue from operations and 17 crores of other income.
So primarily we are saying that our EBITDA margin is roughly around, I would say 17%, around 17%, 67 on 360 odd crores, which we just mentioned. And then actually we're talking about profit margin, which is largely 2%, 2% net profit margin. Will that be a simplistic view?
That's a fair way to look at it. I'm
Right.
just correcting one thing, Piyush. We are referring to adjusted EBITDA margin over here, not the EBITDA margin.
Sure, sure. Now the question here is that there is a huge difference between the EBITDA and net profit. What's the sort of amortization we are making, and what's the sort of average year of amortization we are actually marking on our digital platforms? Looks like we are marking amortization on the technology. So what's the sort of
That's right.
amortization happening there?
Last financial year, we booked a cost of 18 crores. And we believe this number is only tapering off now
Okay.
because we were in the penultimate year of bulk of the capital assets that we had created, which is technology essentially, getting fully amortized. So FY24 and FY25, post FY25, we see this number falling down drastically as we move ahead, which would increase the bridge from PBT to EBITDA actually significantly. We also expect our interest costs to taper off to a certain extent as we move forward because whatever working capital was to be deployed has been done to a great extent, right? And now that same amount is getting churned year on year. So we believe that our walk from EBITDA to PBT and hence to PAT would only improve from where we are today, given the drop in amortization expenses over the next few years.
Sure. Then let's spend a minute on the interest cost and the fundraising which you're doing. What's the total amount of fundraising which you're doing, fresh issue for the company and sale by the promoters?
602 crores is the primary infusion, the fresh issue. This is entirely going to be available as growth capital for the next few years. And the OFS comprises of close to about 12.5 million shares, roughly, which should be in the bracket of about 176 crores, roughly.
Right. So if 600 crores is coming into the balance sheet, then the next interesting question should be that what's the total net debt, sir, which we have on the balance sheet at the end of FY23?
My cash and cash equivalents were at about 102 crores, and my gross debt was at about 153 crores. So my net debt was close to at about 51 crores.
50, yeah, largely, which is nothing from the perspective of what actually we are generating as a revenue. So largely, then, if 600 crores is coming into the company, are you looking towards eliminating the net debt to zero, or this is entirely available for working capital and acquisitions?
No, so the intent would not be to take the debt number to zero because some of the facilities that we have are fairly low cost facilities.
Okay.
These are invoice discounting facilities, etc. So we would want
Okay.
to maintain a healthy cost of capital in our books, right? And
Sure.
therefore, we would not want to use the entire equity proceeds, which is always higher cost of capital, for replacing my lower cost debt facilities. But there are certain facilities on the debt side which we are repaying from internal accruals itself. That alone should bring down my interest cost over the next few years as we move forward. A large chunk of the primary infusion, which is slated to happen, is actually earmarked for organic and inorganic growth opportunities. Large chunk of it.
Okay, so I think this is where I think the viewers should really understand, because when you spend 500, 600 crores on growth opportunities, it normally results in sharp profit growth, right? Because you are at 7 crores, and when you're spending such a large amount, there has to be some sharp delta. Help us understand what you're looking for. Are you looking for overseas markets, or are you looking for some new technology acquisitions? Like how we should really sort of correlate that in terms of how the earning trajectory is going to happen?
See, our intent is very simple. we believe that the growth trajectory over the next 5-10 years, as far as the travel consumption market is concerned in India, is going to sustain at a very healthy CAGR over the next 5-10 years. If you look at any industry report which has been issued in the recent past, it will show numbers ranging from 14, 18, 20, 22%, right, over the next few years. We believe we are uniquely poised as an organization with a tech stack fully built out, which straddles both B2B and B2C across all products. We believe we are uniquely poised to actually tap into both the corporate market, which is far more sticky, more price inelastic, as well as the leisure market, the retail market, right? Our intent is that we continue to grow strongly in both these markets over the next few years. That should automatically result in strong profitability over the next few years, which should reflect in our EBITDA margins, which should reflect in PAT, EPS, etc. That's the stated intent with which we will continue to deploy this money. On more specifics, our intent would be to look at, on the acquisition side, look at corporate management, offline corporate travel management companies. We've done that in the past also, where we've acquired an offline company and taken it into our online tech stack fold, generating sizable ROCs during this process. So we would continue to look at organizations in that space, as well as we are also looking at expansion in expense management, spend management, because these are additional tools that corporates are demanding more and more as we move ahead. And we would like to continue to offer such solutions as well. These are bolt-on solutions on top of our existing corporate travel management solutions. So these are some of the areas that we are looking at. In terms of geography, India itself is not showing any signs of saturation as far as the market growth is concerned. The addressable market will only continue to grow. So our primary focus will continue to be India, but we are looking at markets such as Middle East, etc. as well as we move forward in terms of how we can create inroads over there, whether that's through local partnerships or other means. That still remains to be seen, but we are looking at other markets, but India will remain the primary market.
Okay, understood. And with that, one question perhaps as we move towards the end of this conversation, what would be the cash profit at the end of FY23?
When you look at cash profit, I mean, would you want to just specify that a bit more, Piyush? What metric exactly are you looking at? In terms of, if you're looking at cash flow from operations without adjustment to working capital, we were at about 55 crores. This was the total cash flow from operations without changes to working capital. Given our B2B portfolio, there is a bit of working capital that gets deployed. And since corporate demand was coming back in a post-COVID environment last year, we did end up creating some working capital limits. But without those adjustments, we registered 55 crores in cash flow from operations, if that answers your question.
Absolutely, absolutely. So I think that sums up everything. We talked about the numbers, we talked about the future path which you're pursuing. We also talked about the fundraising which is happening, overall business model. And I would truly believe that this is going to give a sort of very high clarity for our viewers to really understand the IPO and the company. Rohanji, as always, it was a pleasure having you on the show, and we are wishing you all the best for your IPO and also looking forward to have you again on the show sometime later, maybe after the results.
Thank you. Thank you, Piyush. Thank you so much for having us. Thank you.
And dear viewers, this now is a wrap on this conversation. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.